Welcome to Qualified Opinions, where we test the ideas and limits, the knowns and known unknowns around freedom and order in contemporary politics and society. We invite you to listen as we engage with leading and emerging thinkers across disciplines and issues who will sharpen our thinking on the topics shaping our discourse. What about Japan? It's a question I often hear from advocates of fiscal expansion. It's a question I hear a lot from people who hear me complain that the U.S. debt to GDP is heading to 180% of GDP. Japan has huge debt, 251% of GDP, and no crisis or inflation so far. Doesn't that prove that the U.S. can borrow a ton more money painlessly? Just what did Japan get for all its fiscal stimulus? The most important question, however, is what is the lesson for us in the US of what has happened in Japan? And this is why I am so delighted to have David Bahnsen once again on the podcast. David is the founder and managing partner and chief investment officer at the Bahnsen Group. He's also the host of the popular weekly podcast, Capital Record, dedicated to the defense of free enterprise and capital markets. Welcome back, David.
Well, it's wonderful to be with you again.
So let's dive in. You, at Dividend Cafe a few weeks ago, you had this fantastic video. It's just 15 minutes, and it's packed full of information about Japan. And the occasion for the video was that it was explaining the last 35 years of Japan's economic landscape. And so to kick it off, could you tell us the significance of what occurred in Japan a few weeks ago and why it's particularly noteworthy?
Sure. So, the basic history here of what happened a couple weeks ago is that Japan's Nikkei, which is essentially their version of like the S&P 500, the broad index of the big cap public stock market in Japan, the Nikkei hit an all-time high. The difference where like our S&P, I think, has hit a new all-time high like 17 times this year. And we've been progressively making an awful lot of new highs in the Dow and the S&P over and over and over again for years and years and years. The Nikkei hit an all-time high, I think it was 2 Fridays ago as we're sitting here talking. And the last all-time high was December 29th, 1989.
That's what I didn't know. I was just like, I didn't know that fact at all. So 35 years.
Which is really surreal. Now, some people would say it's surreal because the comeback here over the last several years has been so robust. They were over 10,000 points away from getting to a new all-time high just a few years ago. So it's been quite a significant increase higher. I believe the Nikkei was up about 28% last year and has moved quite a bit in I think 5 of the last 6 years and whatnot. But far more than the move higher to get to the high is the violence of the collapse from its 1989 high, and of course the 35 years of lost time in between. It's one of the biggest economic stories in world history. It is highly correlated with various lessons and principles that I think are very pertinent in the United States and also in Europe.
Yeah.
It has generated a lot of conversation over the years as to what could have been done differently, should have been done differently. But it's allowed someone who is kind of obsessed with economic history like myself to really try to find the principles at play. And this thing with Japan is absolutely fascinating because there is no convenient takeaway that aligns with anybody's partisan priors.
So can you give us a little background of what led to the 1989 crash, effectively, in Japan?
Yeah, so the simplest answer, which is kind of unsatisfying, is that Japan had the mother of all asset bubbles, and that bubble burst. And that does require then another question, which is what caused that
The
asset
bubble.
bubble. And so the crash was definitely a byproduct of a bubble in asset prices, primarily in real estate, that then spilled over into the stock market. But what created that asset bubble was really a significant attempt to promote the economy or juice the economy, manipulate it using monetary and fiscal policy in response to damaging things that were happening in the economy, from a strengthening Japanese yen after the Plaza Accord in the mid 80s, and that the corresponding weakening of the dollar and strengthening of the yen for such an export sensitive economy as Japan was having a recessionary impact. And the attempt to smooth that element of the business cycle was treated with an overdose of morphine that then led to a property bubble that is incomprehensible to our view of these things.
So you mean it's like it's worse than that the Great Recession? It's worse than, so we just have not experienced anything like this.
Now in category, in kind, it's almost identical to the Great Recession, but in degree, it is far worse. I think that some of those houses that we know of that were really not all that impressive and maybe were previously trading at 300,000 and then they became $1 million homes, and there were all the foreclosures and stuff that we saw in different suburban communities in America, that there was an excess of supply, there was, easy money and very bad loan qualification. So 4 or 5 factors that pushed up property values to a bubble, but still the sheer numbers of it, they pale in comparison to what was happening in Tokyo. And then what happened is there was so much incredible money sloshing around that the financial system had to then go buy assets out of Japan. So you saw a tremendous flow of capital. Famously in America, it was sort of embodied in their symbolic purchase of Rockefeller Plaza here in New York City,
Pebble Beach.
Pebble Beach in California, and just all kinds of trophy assets that ended up, when all was said and done, trading at $1 billion more than their real market value, things like that. And that's
I remember when I was growing up in France, the Japanese were buying French castles too, and there was just a lot of alarm about that.
Yes, and those kinds of things were being done because there was such a glut of excess capital that had to go get parked somewhere so they could bid up French castles, they could bid up American golf courses, and it just really distorted asset prices. But it really, in Tokyo though, it was unfathomable what was happening. And of course, this was being financed by banks. The bubble, of course, burst. And then we began the process that I think is most interesting to historians, which is why it took 34 years. And I don't think it's over. I mean, the Nikkei may have gotten back to a new high, but we have to understand that Japan has a 230% debt to GDP ratio. And still, as we're talking right now, they're the only country on earth that has negative interest rates in their yield curve. Their central bank is their bond market, for trillions of dollars of quantitative easing that our Fed did. They're not even 20% of our bond market.
Yeah, you have charts on Dividend Cafe that shows the difference between the U.S. and Japan, and where you show that the asset, the treasury, their equivalent of asset holding in the central bank is over 50%, right? Do I remember that correctly?
That's right. And that's just the sovereign debt. Okay. And so they were able to finance their deficits because of the central bank. But unlike our central bank, which can't legally buy assets other than treasury bonds and government-backed securities. So they ended up buying a lot of mortgage bonds because Fannie and Freddie were effectively government sponsored. But like our Federal Reserve cannot buy the S&P 500. Mm-hmm. They can't buy corporate debt. Japan's can. Now, some might immediately want to point out, oh, yes, they did because they cheated after a financial crisis and after COVID. And it is true that was largely done, though, for forward guidance to signal to the market what they would do. And they ended up buying a very small amount. But even then, they had to legally buy it with equity injected by Treasury. So Congress had to pass TARP and Congress had to pass the CARES Act, which then allowed the Treasury to inject loss-absorbing capital, and then the Fed could leverage that up with Fed money. So legally, our Fed can't do what the Bank of Japan did, which was just flat out use their balance sheet to buy risk assets in addition to over 50% of their governmental bond market.
And so the reason why you did the video was because of this event that the stock market had finally reached all-time high 35 years later. But in the video, you said something which to me is even more horrifying, is that the nominal GDP also took 25 years. Did I understand that?
Yeah,
correctly?
I mean, the compounding, if you do a CAGR, 0%. It's
Yes.
0%.
And that was like, we talked about the impact of growth. Growth is magical, and it's for its economic effect, but also for its ethical effect and its impact on culture and all the things that we like, tolerance and health and freedom of religion and all of this. And it's just like when I heard this, immediately I thought, well, I knew about the lost decade, and I want to actually talk to you about this because, right? I mean, like, I just want you to talk to us about those 35 years because, again, I hear Japan mentioned all the time as evidence that we can absolutely, borrow and borrow and borrow and borrow and not worry about our debt level. Let's not even mention the malinvestment that comes with government being so present in our economy. And people say, look at Japan. And I always respond by saying, what? Like the last decade. But what I realized when I watched your video is like, it's like the last 35 years, really. That's what we've been talking about.
Yes. And so that's why I would say that this doesn't align with any partisan priors, that for those who believe, see, the government intervention can all just work out fine, they have to be willing to say that by fine, and using Japan as a model for fine, that they are referring to 30 years of no economic growth and all that means morally and culturally for jobs, wages, and profits. Japan has an upside-down demographic tree. It's an aging population. They also do not have a military to fund. Now, there's plenty on the right in America that say, oh, good, less foreign adventurism and whatnot. But at the end of the day, in addition to not having foreign adventurism, Japan also doesn't have any domestic productivity. And so while Japan has, in my mind, not exactly provided a model for the left story because of the no economic growth, the right's version that any day now, the national debt means that we're going to all fall into the ocean is I think, distorted. The reality of our predicament fiscally is that we don't know where the breaking point comes, and yet Japan suggests that we may not have a breaking point. We may have something I consider worse.
I agree. I entirely agree. It's like if we don't have a financial crisis, but we have this horribly slow growth or no growth, or like real wages going down or being flat or whatever it was.
It's death by 1,000 cuts. It's also the I think T.S. Eliot's famous line, how the world ends with a whimper, not a bang. I don't know that American society, first of all, is 3.13% real GDP growth from 1946 to 2007. So from World War II till the financial crisis, we grew over 3.1% a year, net of inflation. And since then, we've grown at 1.7%. So let's call it half. Okay. And that is in a lot of ways an explanation for where the populism of the last 8 years has come from, for both left-wing and right-wing angst with the status quo, with distrust in institutions, with political tribalism, with candidly candidates for president that no one is all that thrilled with on both sides of the political aisle. This is a byproduct of us being totally broken from trend line economic growth. 0% growth? That feels like a recession to us. We don't have an option of 0%. 0% for us is rioting on the streets, in my opinion. And we go through 1% economic growth and crazy things happen politically and culturally. 30 years of it?
Yeah.
The moral legacy to our children and grandchildren of the country that is responsible for a greater amount of output than anything combined in world history, it's unfathomable. And yet the debt to GDP ratio that we have gotten up to, it's nowhere near Japan's, but it's near double our post-war average. And so my lessons from Japan are right-wing catastrophism is not coherent in the Japan narrative, and neither is left-wing complacency, but rather the idea that policymakers can cause us to push on a string, that we can get to a point where monetary and fiscal policy both suffer from the law of marginal utility. They have a diminishing return effect. And that then, much like the patient with pain medication, perhaps a more crude analogy is hair of the dog. When the person who drank too much doesn't want to take the hangover, you can't just keep binge drinking. And that's I think in a lot of ways what we believe is next. Let's just keep pouring on monetary medicine. And what happened with Japan was it became ineffectual. And then it misallocated resources. And that was the point of the video that you watched. And I think it's the major takeaway of the entire Japanese narrative, is that in our attempts to fix something, we misallocate resources. This is a very Austrian concept, that you create malinvestment, and in delaying the liquidation of debt, you keep good money from getting to good projects, and you force good money to stay in bad projects, which makes it bad money. And that inability to let the economy heal, which was going to take pain, and yet what they did is, instead of taking a lot of pain for a very short period of time, they took a medium amount of pain for a long period of time. And I think that ultimately the precedent of post-financial crisis monetary policy is largely very, very Japanese. QE, Ben Bernanke was emboldened by what he viewed as the success of Japanese quantitative easing. But the standard for success was that they didn't fall in the ocean, that cats and dogs weren't falling out of the sky. The success to me is not 0% GDP growth. And it's true that many on the right who thought QE was going to tank the dollar, that they were wrong.
Or even raise interest rates. I was one of those people, right? Inflation wasn't my area of expertise, but I'd heard so much that, you print money and you do all this. And I just didn't realize, like the impact of actually the Fed paying reserve on banks and so it's, there's just a lot of people were wrong, obviously.
They were wrong, but there were reasons, right? There were certain nuances that were being missed, but they were not wrong that there'd be unintended consequences. They were wrong about what some of those unintended consequences were. My belief is that the legacy of quantitative easing is the incredible incentive it gives to leverage up incumbent productive assets instead of creating new productive assets.
Oh, and by the way, it's also worth saying that, we didn't have inflation per se, but we had really asset babbles. Value of land, value of a lot of assets went up in flame. And actually right now, I think kind of a lot of people on Wall Street are clamoring to go back to these policies, right? There's a lot of pressure on the Fed to lower rates, even though inflation is not, it's like, I mean, the plane hasn't landed yet. So this is the thing that has frustrated me. And this is why I was just so happy to see this video. And I really want everyone to see it. It's the perfect illustration of what I have believed for a long time, which is no. The worst thing that's going to happen to us is it's not a massive debt crisis like Greece. It's going to be something like looks more like Japan. I hope not at that scale, and we already have lower growth. I assume part of basically the burden of government and there's a big economic literature on the impact of actually debt on growth.
Well, that's exactly right. And I think that the idea that, all of this government intervention will make the economy too hot, and I come and say, no, it will make distortions in the economy, it will misallocate resources, and it will cool economic growth for sustained periods of time, low, slow, or no growth. The fact that I'm not predicting a hurricane doesn't mean I'm not predicting an earthquake. It's just a very different meteorological outcome. And so I'm not interpreting this as a benign outcome, but I do believe that sometimes when you're a gnat, everything looks like a windshield. And the attempt for many of us that are advocates of a stable currency and a strong dollar and rules-based monetary policy to look for inflation in every corner when the precedent of Japan has clearly been structural deflation and disinflationary forces that have been just utterly terrible for their economy. I think that we have to understand that sometimes the bad things can happen, but they can be different than we believe. Now, there's people that will say, well, the bond market, has allowed it to continue. And that really begs the question, why is the bond market allowed it to continue? Why was American debt $1 trillion when I graduated high school and the 10-year bond yield was 9%? And now it's 34 trillion and the 10-year bond yield is 4%. I believe that growth expectations have come way down. That more or less the long bond yield is a measurement of nominal GDP expectations. And how nominal GDP is formed, in other words, the composition of growth plus inflation matters. But for purposes of, in other words, you could have a bond yield at X for good reasons or for bad reasons, depending on how much of nominal GDP is real growth and how much is inflation. But either way, there's clearly very low expectations of nominal GDP growth.
I'm very happy you're saying this, and you're saying it much better than I would. But I've always wondered, when people were talking about interest rates being low and they will never go back up, the reasons that were given were, demographic trends and all this. And I always thought, what about low growth? Lower growth, at the very least, lower growth. And it doesn't seem to be something that people actually think about. And so I just, so what do we do? How do we communicate the lesson? What is it that we're doing wrongly? I'm responsible for this in large part because it took me a very long time to understand, right, that kind of massive debt to GDP doesn't necessarily mean enormous debt crisis, and it could, right? Under some circumstances, you could see it, but it really doesn't have to, and yet it would be worse. For instance, like you in the video, you describe how the hangover effect of asset bubbles are worse than the burst itself, and it leads to widespread economic damage beyond the loss of the bubble. How do we communicate this to people who can rightfully say, listen, you guys have been crying wolf for decades, right?
Oh,
and nothing has happened. And to which I respond, well, actually, low growth is happening. So what should we do?
Well,
What's the message?
I think that is the message, that I do not believe in economics of Chicken Little. And one of the reasons is that we've lost a lot of credibility. And so while it makes for a lot of newsletter subscriptions or profits for gold salesmen or things like that, it isn't economically credible from the testimony of history to constantly be predicting the end of the world. But on the other hand, the notion that we should abandon a message of fiscal responsibility is crazy. I would argue that we need to tether our arguments for fiscal responsibility to Japanification, that we need to make the argument that we face a generation of low, slow, or no growth because we have crowded out the private sector, because we have increased the portion of the economy that is now coming from the non-productive governmental parts, and that we desperately need price discovery and desperately need proper allocation of resources. These are classical, simple economic concepts, but that excessive fiscal intervention, Keynesian, and excessive monetary intervention, which is really a byproduct of more recent sort of neo-monetarist innovations. I think we do need a more humble Fed. But what the right has done in the last couple of years when inflation spiked is deify the Fed. And they didn't mean to do it. But by saying over and over, oh yeah, the Fed created this inflation, and now as the inflation comes back down, the Fed takes a victory lap, it reinforces this silly idea that the Fed can be the sort of lever puller of the economy, and that sometimes they'll have things running too fast and then they can help run it slower again. The idea that the reason we have inflation is because too many people are working. The just craziest thing I've ever heard, this Phillips curve, obsolete nonsense model, but the right implicitly ends up agreeing with it. And so politically, I don't think there's anything that can be done. The mere suggestion that we're going to face deflationary pressures or disinflationary pressures sounds to too many like I'm defending Joe Biden, which I'm obviously not doing, but it's removed from a political narrative into a more long-term and thoughtful economic narrative. And that doesn't sell real well on cable news or the internet. But the fact of the matter is that we need a message of fiscal responsibility tied to economic growth. And I always thought that was the right-wing message I signed up for.
The other thing that I thought was very interesting that you did, and that just jive, and I really kind of believe this is also a failure that we have, is that you talk about fiscal and monetary policy as being joint in a way, the interconnection between fiscal and monetary.
Yeah.
So I grew up in the movement, so to say, and I was like a fiscal expert. I was doing budget. I was looking at the budget and I thought, you know what? Inflation, monetary policy, boring, right? Plus during the Great Recession, I was like, oh, we're going to have inflation. Thankfully, I didn't say it out loud too many times, and I was proven wrong. So that kind of just convinced me that I probably should stay in my lane. But what I've learned this time around is actually there is a very strong connection. And there's just a lot of that inflation was created from the fiscal side, right? There's a fiscal inflation. And I also am learning that actually the Fed can't do it alone. The fiscal side is probably getting very much in the way of the Fed's attempt. The other thing that I thought was remarkable was that, again, not very informed about inflation at the time, people were like, don't worry about inflation. The Fed has the tool. And I was like, then I realized what it meant. What they meant was the Fed has the tool, meaning raising interest rate and crashing the economy. And I was just like, I opened my eyes to the danger of the separation between the fiscal and the monetary, between this worship of the Fed that is very unhealthy. And I was just like, I thought that was just one of the also very powerful thing about your video, to talking about the interaction between fiscal and monetary.
Yeah, and I think that that's really been the story in the U.S. since kind of the Greenspan, Rubin, Summers years of the 90s, and then in a much more unhealthy way, post-financial crisis and post-COVID, where it's a Treasury Fed accord. and that interaction. It's one of the reasons, by the way, when people say, oh, can you believe what's going to happen when bond yields go higher? And with this national debt, the cost of servicing the debt is going to be extraordinary. And I say, well, yeah, that's certainly true by math, except for it's never going to happen because the Fed's not going to let it happen. The Fed will have to push long yields down because of that governmental debt. And that is a marriage between monetary and fiscal that I think is totally unhealthy.
Yeah.
But it's the precedent of Japanification. Now, how can the Fed push yields downward without distorting the economy, without misallocating resources? So they need to do it because we're not getting enough productive growth. But then what they do to do it takes away productive economic growth. So we get stuck in this spin cycle. And I think that the marriage between monetary and fiscal that you're talking about is one of the most unhealthy consequences of it that now gets into a negative feedback loop. What central bank head is going to say that we let the US government debt to GDP go up to 34% because of debt service? They can't. And so, yes, your friends are right that they have the tools to keep that. But those tools
at what cost?
Exacerbate the boom-bust cycle. And that's the cost that people keep saying they're against, or we're so against wealth inequality. But then they adopt a monetary policy that artificially boosts asset prices.
Apparently in the 80s, though, Chairman Volcker told President Reagan at the time, said, you better get your fiscal house in order because I'm not lowering my rates to accommodate your deficit.
I have heard different theories about that. And I, of course, am very good friends with a lot of the supply side guys. My view of it is I agree with Milton Friedman's definition. Inflation is too much money chasing too few goods. And I think that what we'll never be able to fully measure, although my friend Brian Dimitrovich has done some great work here in his doctoral dissertation, I think that what the Reagan side did is create a lot of new goods. And then what Volcker did is limit money supply. And so on both sides of the equation, you had anti-inflationary forces. But I'm a supply sider through and through. I'd love to solve for inflation with more goods and services. The thing is, Reagan brought the tax rate from 70 to 28.
Yeah.
So what are they going to do with the tax rate now? Go from 37 to 36?
But it's also kind of, we forget also about the fact that he did do a lot to increase the primary surplus. The reform of Social Security, whether we like it or not, effectively what it did was raise the primary surplus and send a very strong signal that the U.S. was actually more fiscally responsible. We get none of that right now. I was actually the last budget I was looking at. I was looking at the Obama years, and by 5 years later, Obama had actually reduced the deficit by rolling back stuff. It's not as if he was cutting spending, but because of economic growth, by 2/3, right? There's none of that going on. The deficit is going up, it's going back up. And so it's a very different concept. What do you think is the most mistaken claim that people have when it comes to Japan?
I think that for many on the right, it is simply not knowing it, not understanding it, not knowing that there is a counterfactual on the table. That when one says excessive fiscal spending is inflationary, excessive monetary intervention is inflationary, they are not aware of the land of the rising sun creating a 30-40-year counterfactual. And that those on the left seem unaware of the fact that Japan has not contributed to the global economy for 34 years and has basically the legacy that they've left to their kids and grandkids has been completely unacceptable. I think that the basic history of it, for those that look at it and need to get the right lesson from it, which I think is your question, it is that there is a law of marginal utility that applies to fiscal and monetary as well. And we get downward pressure. Some of the economic complexity behind it is a result of declining velocity, declining loan demand. When I talk about diminishing returns, the very initial priming of the monetary pump there are good projects to invest in and low cost capital that go finds good projects that can enhance productivity. But then if you keep doing it, there's a diminishing return because borrowers are already levered. So your next borrower is a lower quality borrower and your next project's a lower quality project. But the stimulative monetary policy is incentivizing more of this activity, which is counterproductive economically. These concepts, I don't believe, are that complicated, but I think they're the real lesson of Japan. The thing with Japan is it was at scale. It was one of the largest economies in the world that had this incredible recovery post-World War II into an era of prosperity in the 80s, and they squandered it with intervention.
Well, thank you so much, David. This was great.
Thank you very much for having me. I love the conversation.